What's up, strangers? Welcome to the Wealth Game Nation. My name is Vedo, and I'm here to help you better understand the wealth game and become part of the Wealth Game Nation. In today's video, I will talk about 10 biggest investing mistakes you can do. So let's get right into it. First on the agenda, we will look into why do we make these mistakes. Then we will look at the 10 biggest investing mistakes. Then we will look at some honorable mentions. And then how to invest successfully. Why do we do these mistakes? Bad investments. They are everywhere. The ads, the radio, the commercials on TV, on YouTube, they are everywhere. We all have been there, we all have done that. We all have done some bad investing. Why do we do this? We do not do this with any other purchase. For example, if we want to go and buy a cell phone or a laptop, we will find out everything there is to know about the device. We will find out how many pixels, what's the memory, what's the screen size, and so on. When we will buy a car, we will go examine the car, we will have a friend or a mechanic look at it, we will check the history, we will look how well it has been maintained. If we're gonna go buy a home, we will know everything about the home, we will know what kind of area it is there crime there, or the school there, what kind of connections, public transport connections are there, is there a homeowner association. We will find out everything, but we do not do this for our investments. And the reason for that is a lack of education. This stuff is not taught in schools, so it's very difficult to learn because we have to do it ourselves. And also, investing has become synonymous with gambling because, as I mentioned, there are so many ads. Come join, few clicks, it's easy, and you're off to. You can be a trader. You can be, we'll take you to the moon with next whatever, and so on. So people are, in some ways, looking at investing as gambling. Just to mention that the list of major investing mistakes is much longer than the 10 that I have listed, but let's get into the 10. First, not being able to afford investing. For example, credit cards, student loans, huge car payments, high mortgages, not steady incomes, not enough money in the emergency fund. Those are all reasons why you are not able to afford to invest. Maybe you are still investing, but you should not be because you need to get rid of all your credit card debts, student loans, car should not be paid in payments, it should be paid in cash. Mortgage should be a fixed mortgage, and that should be the only debt that you have. You should have a steady income, you should have enough money in the emergency fund, maybe 3 to 6 months. So why would you invest into a stock market, for example, that on average is returning less than 10% and your credit card debt is 20%? So that makes no sense. First, go take care of everything else and then go into investing. So this is a pre-investing mistake. Next one is not having a plan or a strategy. So you need to understand different asset classes and their historical returns. There are different asset classes. It's not all of them are the same. Not all of them are correlated. Not all of them have the same historical returns. Not all of them have same risks. So you need to understand them before you can go into investing. When we talk about the stock market, you need to understand how indices work. What are ETFs? What are index funds? What are mutual funds? What are dividend paying stocks? What are growth stocks? You need to be able to read financial statements. You need to evaluate the risk and the reward when buying a company, and so on. So this is all lack of knowledge on our part, and this is also a pre-investing mistake. Third one is not investing at all. There is always something that will try to convince you that it's not a good time to invest. So whether it is conflicts in the world, there is a recession, there is inflation, pension funds are being talked about, they're not going to be there when people go to retirement, and so on. So there's always something. But if you look at the long term, people are creating value. So companies are creating value, and that's why the standard and the value of assets are going up in price over time. This is also a pre-investing mistake. So if we look here, we have now done 3 mistakes without even investing a single dollar. Let's continue. Number 4 is buying companies that we do not understand. Not doing your own research. For example, you need to know if the company is cash flow positive. You need to know how much company does have in debt. Next one is investing all at once. This is a mistake that I have done in the past. So I have invested a lot of money all at once without doing proper dollar cost averaging. I did not understand that the stock fluctuates, the price of a single stock fluctuates 50%. So if, for example, if you buy a stock at $100 per share, within the next year, it may go down to 50 and it may go up to 150. And if you do it all at once, you may risk it. So you should always dollar cost average. Number 6, also something I have done in the past, is investing in IPOs, initial public offerings. You gotta think about this. Why would a company decide to go public exactly when it's time to share the profits? They don't do this. Nobody does that. They go public when they need money. There is so much value to be found in the stock market with companies that have been around for 10, 20, 50 years and nowhere close to something that you will find in an IPO. But still, our nature is like that. We go after the new shiny thing. Number 7 is trying to time the market. Buy high, sell low. It's the opposite of what people are trying to do, is buy low and sell high. We end up buying high and selling low. This is because people are trying to time the market. They don't understand what they're buying. They're trying to buy the dip. They buy something at $100 per share and then it goes down to $80 per share. You buy the dip again because you had some money more, and then now it goes to 60 and you don't know why it's going down, and you panic and you sell. So you sell at a loss. Number 8 is putting all your eggs in one basket. So investing all into one asset class, or even worse, into one property or one company. You need to understand what are different asset classes and then also diversify within that asset class. The mistake is not diversifying enough, trading too much too often. Trading does not work. Technical analysis and charts are not the holy grail of investing. Looking at charts and saying, okay, this is the zone of resistance and this is the zone of support, and if we break through here, that's going to happen, or if we fall down here, this is going to happen. This does not work. The stock does not know what's its price. The stock does not know what does the technical analysis say about the zone of resistance. What does work sometimes in these things, when too many people are looking at the technical analysis and then just basically trading based on this technical analysis, and then basically it becomes a self-fulfilling prophecy because everybody is looking at this. But this does not work in the long term. Investing should be long-term, if possible lifelong. So when you buy something, you should plan to own it forever. Number 10, paying too much in fees. For example, there are people who invest in mutual funds. Mutual funds are actively managed funds and they have high fees versus an ETF, broad market ETF, or an index fund that maybe charges 0.2% versus 2% of a mutual fund. If you think about that, the stock market returns on average a little bit less than 10%. And for example, and the mutual funds cannot, or usually 99% of the time do not outperform the broad market. Let's say the mutual fund manages to make 9% return, you give 2% this year, that's 7% return on your money. Next year the same thing, next year the same thing, and over 10 years you end up with making half of what you would have made if you would have invested in an ETF or index fund. Now let's look at some honorable mentions. As I said, there are much more than 10, but let's go fast through some honorable mentions in no particular order. Investing money that will be needed in the short term. For example, if you have a down payment on a house, kid is going to college, you have a wedding coming up, you should not be investing this money. Investing in hype stocks, so AMC's, GameStop's, Bed Bath & Beyond. These companies are not profitable, they're meme stocks, they're famous, they're known, but they are not good investments. Same thing goes for hype crypto. For example, you hear somebody say, this is the next BTC, or this is the next ETH, or this is the BTC or the ETH killer. This is going to go to the moon, or stuff like this. This is just pure hype. And short term, yeah, maybe, but long term, this is not a valid approach. Then taking raising or falling prices as confirmation that you were right. So basically, people sometimes they do predict something and they're like, look, I have predicted it's going to go up or down. For that, Benjamin Graham, the author of The Intelligent Investor, says in the short term, the market is a voting machine, but in the long term, it's a weighing machine. So basically, in the short term, people just who are frantically buying and selling, and they are voting, and that's how the stock price is being affected. However, in the long term, it's going to be a weighing machine because it's going to weigh the real returns and real operations of the company. Next one gives me chills. I don't like this at all. Taking advice from prominent figures, your favorite actors, singers, athletes, social media influencers, all of them are getting paid publicly endorse something that will be profiting from regular people. So you buy it and they profit from it. They don't care if it's a good product or if this is going to do something. You should stop doing this. Last but not least, watch grass grow. So basically constantly watching the markets, listening to the news, reading what's happening in social media. Investing is a marathon. It's not a sprint. So try to zone out of these. Now let's see how to invest successfully. Basically do the opposite of what I have been talking about so far. Also subscribe to this channel. This is where the good knowledge is being shared and spread. My investing strategy is I keep a long-term mindset. I never get out of the market. I'm doing dollar cost averaging no matter what. Well, at least now I'm doing it. I do not waver from my long-term plan. I have set up my overall portfolio. Majority is for example, in stocks and real estate, and then a very small portion is in crypto. I try to make more than I spend, and I invest the difference. In order to do this, you need to track your income and outcome. You need to make sure that you are really being cash flow positive, just like a company. A KISS principle: keep it simple and stupid. In theory, do not overthink it. Don't try to make it more complicated than it needs to be. In practice, don't leverage. Don't try to time the market. Don't short it. Don't do trading, and this is just not gonna work in the long term. And last but not least, diversify, but don't diversify. This is a term coined by my favorite investor / comedian, Peter Lynch. So that's it. That's all I have for you today. Thank you so much for watching. I hope you have found value in this video. If you did, please make sure you share, like, and subscribe. If you have some feedback on my list, if you have done some of those mistakes, point them out to me, write me a comment. Thank you very much, and I'll see you in the next one.